Thank you for watching this preview video at xm.com. We'll be discussing upcoming U.S. CPI inflation data and the potential reaction in the markets. I'm Maria Bachardez, and joining me is investment analyst Cristina Parthenidu. So Cristina, the U.S. economy continues to show resilience, with the latest data indicating a strong jobs market and wage growth. Now on Tuesday, we'll get CPI inflation data for January. What are we expecting there, and how might those figures impact the Fed's next moves?
Hi, Maria. Indeed, the U.S. economy performed better than expected in 2023, growing by 3.3% in annualized terms in the fourth quarter, which of course reminds nothing of recession or even a soft landing. Well, the central bank has estimated a weaker GDP growth in 2024, but January's data came surprisingly stronger than expected. The labor market continues to create a significant amount of job positions. The unemployment rate is still around a record low, and the average hourly earnings are still rising above the inflation rate. So that suggests that consumers have enough purchasing power to drive demand for goods and services higher. Well, January's ISM business PMI figures also came higher than expected, especially in the services sector, showing more hiring and higher new orders. But what was more striking was the unexpected increase in prices paid by businesses, which rose to the highest since March 2023. And that made investors think that the fight against inflation is probably far from over. So investors will probably look for more clarity when January's CPI inflation data come out next Tuesday. Forecast suggests a stable headline CPI of 3.4% year on year, and a weaker core CPI measure, which excludes volatile items such as food and energy, that is expected to ease to 3.7% year on year. If that proves to be the case, investors may keep defending the scenario of a rate cut in May after the Fed played down the case for an earlier rate cut in March. Now, if inflation faces a second consecutive increase, if the headline CPI extends December's rebound, and more importantly, the core measure turns up too after a couple of months, that could be, I think, a game changer. In this case, investors could move the case of a rate cut from May to the summer, since the odds for rate cut in May is around 55%. In futures markets, we shouldn't forget that the Fed wants to see a sustainable path towards its 2% inflation target. So as long as the data hold comfortably above that level, policymakers will keep pushing the scenario of rate cuts further on the horizon. And of course, given the geopolitical tensions and the risk of wage growth preventing inflation to move towards the central bank's 2% target, I think that it may take some time before the Fed starts to support a more accommodative monetary policy, or even starts to send more clear signals about a rate cut.
Turning to the market reaction now and taking all this into consideration, what's the outlook for the dollar?
The US dollar is still strong. It managed to recoup its previous losses against the Japanese yen, and it also gained more power against European currencies thanks to the upbeat US data releases. And perhaps another strong CPI report could help the currency to move higher and even reach the 151 level against the Japanese yen if the pair successfully surpasses the 149.70 resistance. Now, if inflation heads lower, that could somewhat question the Fed's stance on rate cuts, and it could press the dollar lower. From a technical perspective, dollar yen is facing support within the 147.40, 147 territory. So traders may look for any break below that floor to shift their attention to lower levels. So overall, I think that the next CPI release could be important to watch, as it will be the first inflation report of the year. And given the uncertainty around the scenario of a rate cut in May, I think the data could generate volatility in the US dollar pairs.
Christina, thanks so much. This was a preview video here at XM.com.